Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time, and it is the 10th of the 12th, rather than the 12th of the 10th, December 10th. And we have Brent crude oil trading down this morning, not by much, a few pennies, about a third of a percent, but below $72 a barrel, which of course is the tendency returns each time the geopolitical tensions seem to ease off. That Brent price keeps looking at that $70 a barrel and wants to bite it. That's what it's been looking like for a while, but it has always recovered and not bitten it since September 10th. Let's kick off this morning with Mukesh Sathev, Global Head Commodities Market Oil at Rystad Energy. Mukesh, we've had some fairly robust news in the last few days. If you want to put in the geopolitical risk bucket, Syria, after 50 years, a major moment of turmoil there. We've China import data for November coming in, looks pretty robust. Now we're nearly 12 million barrels of oil imports per day in November. And now we've had today the China stimulus 4.0, 5.0, whatever it is, an announcement of determination to stimulate the Chinese economy. All things considered, the oil market seems uninterested. What's the problem?
Sean, that's an interesting question. I think this has been the norm, I guess, that sometimes the market reacts more to the bad news rather than the good news, right? I think that's one phenomena we have observed. The other thing I would say is this is the end of the year, and I think unless the Trump takes oath and the real policy, shows up and all the cabinet appointments are made, I think market will be staying in a wait and a watch mode. So I think that's why market is probably not reacting to this news. And the Syria one probably is also the geopolitical risk has subsided down. And even if Syria is not a major player in the markets either, so I guess that's what is going on. End of the year, wait for Trump, and not taking all these positive news in the stride. That's what is happening.
Peter McGuire, CEO of XM Australia. Peter, you obviously watch China closely. It does incrementally appear that they do have some backbone on this stimulus campaign. They're not letting it go. The dogs keep barking on it. What's your thoughts on its outlook and its possible impact and into the new year?
Well, Sean, and greetings from Sydney. When you're looking at it, is a good news story, and you've only got to look at their stock market over the last year. You've got the Shanghai Composite up 16.5, and you've got the CSI 300 just shy of 19%. So it's not a bad rise. The market's inhaled it. It's up the best part of 1% today. So it hasn't shot the lights out to say, well, wow, here it is. It's up 3 or 4%, but it's positive. At least it's green. And the overall growth momentum seems to have back engaged, and it hasn't really washed out too badly compared to where it was a couple of months back. It's had that continuation as far as bullish uplift. So whereas the China story, Sean, I think they're waiting to see what impact, again, building on Mukesh's statement, President Trump, only a 60% and possibly a 70% tariff that they're going to inhale. How are they going to manage that? Small to medium-sized enterprises are going to be crippled, and we know what the large ones are going to be like. It's going to be tough times. So I sit here and say, let's get on to the January 20 and see how this impacts markets, Sean.
Welcome back, Jamie Ingram, Senior Editor at Middle East Economic Survey. He has that look of the I'm now a dad, and Mabruk and congratulations for you on that, Jamie. In the last few days, Jamie, obviously between the OPEC plus decision to roll over their cuts into deep into the end of the first quarter, a few days later, of course, the developments in Syria, the market seems to be ignoring both of those. Or your thoughts on the OPEC plus decision?
Thanks, Sean. Thanks for the warm introduction there. Yeah, absolutely. I think let's start with the geopolitics of all of this. We've had over the last year and a bit some, vast amounts of geopolitical volatility within the Middle East region, and it hasn't impacted oil prices that much. Yes, there's been periodic spikes, but nothing stuck. And that's because over the years, markets have grown increasingly accustomed to riding out this kind of volatility. There's a confidence that the guys like OPEC Plus, there's spare capacity in the system. The systems themselves, the infrastructure, the mechanics of getting oil from A to B is robust enough to ride out this kind of developments. And frankly, Syria is nothing in comparison to some of the areas that have been affected by geopolitics recently. It's not a major
But does it
producer.
not bring Iran more into focus? I mean, Syria is Iran. Iran is Syria from the point of view of at least geopolitical twins over the last 50 years.
Sure, but when it comes to, pointers towards, a major conflict between Israel and Iran, this is not the most significant lever that's been pulled recently. I think people are fairly sanguine that we're a long way from Israeli targeting of Iranian energy assets, even in a scenario where the conflict between the two of them does heat up further. We've got a long way to go before either side targets hydrocarbons. So I do think that markets may, you could certainly argue they're too blasé, but certainly the perception is that this is not an issue that's going to be impacting on supply and demand fundamentals, nor is it going to impact on the logistics of it. How the Houthis respond to the kind of the perceived weakening of their major patron might be interesting. But again, when you look at Red Sea dynamics, most of the oil's already been diverted. So even an uptick in attacks in the Red Sea again isn't going to have a huge impact on fundamentals. And then just going to OPEC Plus. There's a little bit of quiet confidence within when you talk to some of the delegates there that the oil market performance this year might not be as bad as has been feared. There's a little bit of confidence that there might be some upwards revisions to come in the months ahead, but ultimately they're looking at what the impact is on inventories in Q1. Again, it's trying to be preemptive as they talk about it, being very cautious, making sure that, okay, the narrative is very much we're heading into a weak demand season, so let's not push the boat out and bring volumes on and hope for the best and that we can accelerate things further down the line.
Mukesh, just picking up on that, I mean, over the last few years, we've seen OPEC Plus move from being very much literally in the driving seat of this oil market coming out of COVID, and then maybe they kind of moved to the front passenger seat for a period of time. Are they still in the front? Or are they on the back seat? I mean, where do you see OPEC and OPEC Plus in terms of their grip on this market, moving particularly forward rather than backwards?
Excellent question, Sean. And I would maintain, which I've been saying for quite some time, OPEC Plus is very much in the driving seat. I call it the two-pedal theory, which I've been talking about for quite some time. While OPEC Plus can be divided into two baskets or two buckets, right? One is the countries which are doing under compliance on crude, for sure. And there are countries like Kuwait, UAE, Oman, which are doing compliance on the crude. But as we know, they are pumping 1 million barrels more product exports to the market. So both are pumping, I would say, directly crude or indirectly crude to the market. Still, that's how I believe that in such a geopolitically hot year, election year, they have kept the prices stable because now they are not just having a pedal of the crude market, but the products market. That's number one. OPEC Plus, in my view, is in strong position. And number two, I would say that OPEC has probably found a very good way because OPEC Plus controls the right quality of the barrels. I've been saying this. Light barrel is the wrong barrel, and we are flooded with light sweet barrels in the world, which is affecting a lot of refining systems in certain way, but the medium sour barrels stay in demand. So that also gives OPEC Plus a very strong. The third
Would that
thing,
give you, just to stay on that point, a second point there, which is the medium sour? I mean, coming out of Venezuela, coming out of Iran, those grades are very much present in those two markets. Does that give you a sense that maybe the Americans won't go so hard on Iran, or given the appetite for that particular grade rather than sweet? I mean, does it color the geopolitical outlook at all, do you think?
No, I would say that it's hard to call on what Iran's stand would be, but I think it's fair to say that it's not the Iran of 2018, which is sending barrels to 5, 6 countries. So Trump or US admission has to do something really big to take out oil out of Iran, and that will increase the prices. And summer is coming. In summer of 2025, I'm sure Trump would not like prices go high. The light sweet barrels, even if they produce more in the US, will not help the prices. So in that sense, I believe that from a quality angle, it will not be. But let me say the third point. I still believe and have an opinion based on our fundamentals data. OPEC is not in a price war. OPEC is in a margin war. OPEC Plus knows that the non-OPEC supply, the Brazil, the Norway, the Guyanas, including the US, is growing. So instead of hurting the OPEC, non-OPEC by doing a price war, I believe that OPEC Plus as a group will continue to keep margins low by putting product exports, keep crude prices high, margins low, drives the refinery runs.
Although yesterday, sorry to interrupt you, but just make your thoughts on the announcement over the weekend of Saudi Aramco doing a 4-year low on their OSPs, which would,
yes,
in any other language, smell and look like a price war, or at least look like a very competitive price.
Well, I think these are market adjustments given we are
4-year lows. 4-year lows is a bit more than
agreed.
a market adjustment.
No, I would say that they have learned higher forever gets lower for longer. So they are not going to repeat that mistake. What I would say here is that the best way to check the non-OPEC production is not a direct price war, but drive the refinery runs down in the countries which are buyers of the non-OPEC barrels. That is what I believe is the 2025 game for OPEC. That's why they are not worried so much about the non-OPEC growth. It will get in check because OPEC will check the refinery runs in those countries which are the buyers of the non-OPEC. So and then I would say they have the bright new refineries in Middle East. They are taking big stakes in Korea, in China. I think as demand probably recovers back and China's stimulus maybe finally works in 26, if not in 25, that's where their game is. So the long game, not so much of a short game.
Peter, just looking at the China outlook into 25 and the announcement today about the commitment to drive consumption, even if they are successful, Peter, and sustain their commitment to the stimulus plan, which is a lot of credit easing and so forth, is that likely to move the needle on oil consumption, oil demand? In terms of it doesn't appear to be targeted at the big industrial, the classic sort of Chinese build a railroad for 1,000 miles sort of projects, that even if they get the stimulus right, it may not move the dial on oil consumption. Your thoughts on that?
Well, you would think it would, Sean, just there would be organic growth. And when you're looking at this, I feel as though you'll get a better picture tomorrow as far as the depth of what they're trying to achieve. When we look at 25, there's no doubt that the Chinese engine internally needs to really gain some traction, and we're very conscious that I think that's the pathway forward. Naturally, from an export-driven model, it's going to be tough for them, and they've got to look at other markets. That's about a 16 or 18% export market goes to the US. The impact it's going to be is going to be quite severe for them from these tariffs. So they've got to do everything internally, gain momentum, and I would think that would be more consumption of naturally crude and more consumption of nearly all commodities. I mean, you've only got to look at their appetite, Sean, what they've done this year as far as gold. I've just made some notes. It's just unheralded. This in the last month, they bought 160,000 ounces of fine Troy, and they've over the last 2 years, you've got a whopping 10 million ounces that they've risen their gold consumption. So they're very focused on the internal engine, and they're probably not playing into President Trump's hand. They're playing into their own hand and other markets to really grow their economic, I suppose, vision towards Africa and very much other parts of the globe.
What do you think is their biggest sort of target in 25 in terms of their, obviously multitude of challenges that face every country, and obviously faces China, peak population, peak other things. But is it deflation? How big an issue is deflation for the Chinese and for the world as a result in 2025, Peter, do you think?
I think deflation's very worrying, Sean. It's not inflation for China, but for a lot of other markets, it's certainly the inflation story that's going to be a handbrake to the likes of the Fed and other central bankers. Certainly in Australia, we haven't even had one rate cut as yet because of high inflation. And then you've got deflation moving into stagflation. And everyone knows from an economic theory, that's the danger zone. That's really peril. That's a frightening scenario to enter there. So where does China play? I think it's got youth unemployment to be a big concern, Sean. And again, what happens with their property market? That still is a property mess. That's still got to unwind all the debt associated with it, who's holding the debt. And we all understand that from Chinese banks and then global banks that are all making up the party as far as who's at the table from a debt perspective. So that's all got to work through. And you don't want to see an aggressive stance forward with something like Taiwan to take focus. And what happens if we were to move into a more, unknown geopolitical standpoint? If Iran enters something shortly, this could really see China involved there as well, Sean. So I think that the first quarter of 25 is going to be a very interesting one and very volatile for markets.
Jamie, looking at the point Mukesh is making there, OPEC still very much in the driving seat of this oil market. I'd welcome your thoughts on that, whether you concur with it or not. Ultimately, OPEC Plus is keeping 6 million barrels a day shut in. It seems like a difficult win, and we see OPEC Plus countries moving into fiscal challenges, and obviously many countries are not complying with their output cuts. So generally, where do you think OPEC Plus is at going into 25? This kind of consensus has been in place now for 4.5 years. Does it still have a lot of legs?
Yeah, I'm not sure that I'd go quite so far as to say they're in the driving seat. They're managing a very volatile situation, but there's a lot of external factors that are outside of their control, quite frankly. You've got the issues of supply side issues within the US, Brazil, other markets, but also the broader economic situation in China. There's a lot of noise that OPEC Plus is having to manage. They're trying to chart a way through this. They've come out with various roadmaps since the middle of this year, charting for production out through 2025, and then more recently extending this monthly, but by month, by country roadmap out to the end of 2026. Certainly, I think that if they were in the driving seat more, they wouldn't have had to have quite so many adjustments to the path that they're plotting through this situation. But it's impossible really to be in the driving seat. That's not to malign OPEC Plus and say that they're losing control of this market. I think that they have to make a managed situation out of all of this. The issue that you raised, though, of compliance is certainly a big issue within the group still. It was a key part of the communique, and there's certainly a feeling within some parties that perhaps they wouldn't have had to extend the cuts quite as far as they did if compliance from some of the members, such as Iraq and Kazakhstan in particular, had been stronger from the get-go. Iraq has definitely improved its compliance in recent months, but they're still overproducing. It's very notable that when you see the likes of the Saudi energy minister going to Baghdad before this meeting, it wasn't just his counterpart that talks were held with. It was Mr. Sudani. It was the head of the government in Iraq. This is an issue that is being raised with Iraq at the very highest political levels.
And on that point, Jamie, just to sort of follow up, the other thing that's happening at the same time as these cuts are being extended, many OPEC producers that can and have the money are continuing to add capacity. I mean, we just had Kuwait announce a week or so ago, $30 billion spend. We know obviously the UAE is banging on the door of 5 million barrels a day now. Oman, I think, is cranking as much as they can, etc.
Yeah, I mean, Kuwait's an interesting one. That 30 billion, of course, isn't just on the upstream. There's a lot of refining and petrochemicals upgrades that they're pushing at the same time. With Kuwait, it's kind of more of a story of some of their upstream projects being deferred, actually. Their efforts to add capacity are not going as smoothly as they would have hoped. Yes, the trend is back on an upwards trajectory, but they're not pushing too much onto the market. The UAE, of course, is always the big one. A lot of conjecture over how they're managing to balance their commitment to ever extending cuts versus the huge amounts of additional capacity that they're bringing online. It really was a notable thing that they agreed to defer their own individual uplift to their required production level from January to April next year. So that, it's certainly being pushed by OPEC Plus as a huge proof of the level of cohesion within the organization that the UAE did agree to delay the addition of extra barrels from them. But
yeah, I'd have to agree with that.
The more the strain could tell on that relationship.
Let's go to the survey question before we put our panelists on the spot to give us their forecast price-wise for the new year. So the survey question is, China's top Communist Party officials have announced a shift in their monetary policy stance to vigorously boost consumption. That was the announcement out of China today. Will China's stimulus campaign drive up China's oil demand in 2025? That's the question I was sort of putting to Peter there. If they're successful, will this stimulus, because it seems now you'd have to say they're committed to the stimulus campaign. They're not letting it go. They're biting at it each few weeks. And the Chinese Communist Party, when they do set their mind on something, they don't tend to let it go. So will they do whatever it takes, so to speak, and will it stimulate and drive up China's oil demand in 25, which in 2024 this year was at best flat, if not declined by a small amount? So yes or no on that? Welcome your thoughts. You have confidence in the direction of the Chinese impact next year. Mukesh, on the spot, I put your boss on the spot a few weeks ago when I had the pleasure of having him on my panel at ADIPEC, and he told us he saw a average oil price in 2025 in the 60s. I'm not sure if he was given the house view, or his own view, but nonetheless, we've seen an $80 Brent this year. Everybody happy days with that, really. If you're a seller, a producer of oil, that's a pretty healthy price for anybody, even if you would want it a little bit more. But where does your team, Rystad Energy Trading, look at the 2025 and where that average price might land?
Well, let me answer, Sean, this way, and also connect back to your original question. And Jamie, I think by the time Jamie answered his question, he was sounding like OPEC Plus is in control. What I would say is that if OPEC Plus can maintain the backwardation in the market, they are in the driving seat. They have been managing very well. They have avoided contango. I was at the APEC, summits, and there were a lot of calls on contango is coming, contango is coming. OPEC Plus has managed to drive backwardation in the market. Whenever the market flirts with contango, they cut and they maintain. So number one, that to me is in the driving seat. Also, I would say that OPEC Plus understands higher oil prices leads to more non-compliance, more of these challenges, and they have been able to maintain that the high prices do not go high. They are in good control. OPEC Plus has also maintained that they will not let the prices go to the 60s. And I think when you heard Yaron speak about, he was mentioning if OPEC goes ahead with the policy of bringing the barrels, as they say, then the oil prices will go down to the 60s. And our view, house view, has been that OPEC Plus will extend the cuts in the prompt, but they will keep announcing we will bring back to keep the back end of the curve pressured, and that's how they sustain the backwardation. So our price forecast is stay in these 70s plus minus volatile range, keep the margins low, and that's what we believe 25 pass through 2025 like that.
Peter McGuire, XM Australia, your thoughts? I know you guys don't do forecasting, Peter, but what is your own sense? Oil prices averaging $80 on Brent this year. Do you think we'll be higher or lower than that in the next year?
I think two things, Sean. First off, I want to see how Q1 plays as far as from a geopolitical stance, and naturally with President Trump coming into power on the 20th, and where we could be on the cusp of something, and let's hope we're not, from a war perspective. And if something was to develop, then you could quickly see prices ratchet up, I think, from a geopolitical standpoint, and put a war premium in. And if things do materialize, then that changes, I think, everyone's footprint as far as a Q1 read. I think it's going to be that 60 to probably 80 handle. I don't, unless you see something dramatic happen. I feel as though that with President Trump there, he's going to increase production, Sean, and so in turn they want cheaper prices. So yeah, I think it's probably erring on the side of probably closer to 60 than it would be to 80. But as you know, that's a wonderful wild market to trade, and there's plenty of opportunity. So we could be well out on either side.
Jamie, last word with you on this same thing from the point of view of a lot of the OPEC plus countries are running fiscal deficits this year due to where price landed at $80 on Brent. Your thoughts for next year?
Well, I think on that fiscal deficit issue, you know, the countries that really count, the countries that are running the show within OPEC Plus, they're pretty content to continue running these deficits. You know, if we take Saudi Arabia, it has a very low levels of debt to GDP. It has a big investment requirements for Vision 2030. It's willing to go to the debt markets to fund those. So I take any concerns over running budget deficits with a pinch of salt. You know, going back to some of Mukesh's comments, absolutely. You know, we see that the recent price drops have focused the mind, as it were, from some of the less compliant members within OPEC, and so that certainly will help them put a bit of a floor under the prices. But then, going back to Peter's comments, it's all about what's going to happen with the Trump administration in Q1, isn't it? You know, there's so much policy uncertainty over what's coming there that it's really impossible to put too much of a handle on prices in 2025. But yeah, I think that OPEC is going to manage to put a floor in at least 65, if not 70.
What did you make, Jamie, just quickly before we go off, of the Saudi energy minister's comments that this was a reality check? I think he made those comments in a CNBC television interview or some platform like that.
Yeah, I mean, that's just basically saying, look, we have to be observant of the market situation here. We can't ignore the fact that the narrative is that we've got a weak market. We can't just pump as much volumes back into the market as we want, just thinking wishfully that more oil equals more revenue. You know, it doesn't work like that, and he's trying to educate some of the other members within the group of the reality of the situation.
Well, we'll wrap it up there. And amongst the things that we can't forecast and the unexpected, well, there we go. China's policy stance could shift. There's confidence in this room that there's a dog biting in that old dog head in terms of China. I think China, like they sort of everybody overestimated their performance this year. I think maybe the market is underestimating what they can do next year. But I think as a little anecdote for this sort of strange time we might be going into, as Mukesh started his comments, waiting for Trump, waiting for Godot. My son is at university in the United States, and as a foreign student who are off for the sort of winter, Christmas, New Year's season, they're all due to go back around January 19th. I think they're 20th or something like that. The new term starts, and they're being advised by their colleges to come back a few days early, just in case on the first day of Trump's administration, there's some bizarre executive order against foreign students coming from wherever in the world. I think there was examples of strange things like that last time. And so the actual university advised them to come early for that reason. That's one on a very long list, I think, of unusual developments that you wouldn't expect to have, but that's one of them. Thank you, guys. Jamie, Ingram, have a wonderful holiday season. Peter, Peter Maguire and Mukesh Sadhep, thank you so much for all of your insights this year. We've closed up the podcast for the season at the end of this week, and we're back on January 9th for that 12-hour 50 market forecast across the world. We hope to see all of you guys on that and kick into the new year. Thanks, guys. Happy holidays.
Thanks, Sean.
Thanks
Happy
all.
New Year.
Some sleep,
New
Jamie.
Year,
Happy
see you
Christmas.
2025.
God bless. See you guys.
All right. See you.